All right. Hello, everybody. Welcome back to another Market Open. Here we are. It is September 26th, 8:45 a.m. And we are in the official second day of the last week of September. And we are going to see what happens in this last week. So I want to talk. There's a lot of things I want to talk about and get to today. One of the first things I want to talk about is kind of the market reaction that happened yesterday, because yesterday's market reaction was incredibly interesting in terms of where the market started, where the market ended, and then eventually, where the market ultimately kept going. And then we got a lot of other stuff to talk to today. So far in the pre-market, we are red. We are pretty red. And yesterday was very interesting because we opened the market down, I think like 1%, and then ended the market up about 1.2%. And that was really interesting because a lot of people sold as the market opened and their stocks tanked. And it seems like it was probably institutions that came up and swallowed up all of those shares when they got really cheap. Now, today in the pre-markets, they're cheaper than they were even when people sold. But it does goes to show that the dip was bought and that for some reason equities began to climb at certain levels. So we got a lot to talk about. Let's get into it. And then we'll get into some of the other juicy topics we have today. Cameron Investing. Hello. Joseph, Sethi Roth, Ramu, Kelly. Thank you for the compliment. Bay Ray, Joseph, Ty Gordon, Petros, Tobor, Imnop, Joseph, Marcus. We may be FLA for this week. Yeah, I mean, it's going to be a very interesting week to kind of see how things turn out. So let's give a little bit of an update on where equities are currently, and then we'll get started in some of the other stories that I wanted to discuss. FDJ, Jeremy, Sasky, Rose, Garcia, Mekhel, thank you all for being here. Sasky says, have you seen the issues with the new iPhone Pro Maxes breaking super easily? I did see some of those issues. I think if that is a real issue, it's more so people just being honestly kind of dumb with their phone and not getting a case on it and like letting it fall super quickly. It's made of titanium, so it shouldn't be breaking that easily, but apparently that's the reason it's breaking easily. I'll probably get a case on mine. I should be getting mine in a week, October 6th. So or about 2 weeks. So I'm excited to get mine, but I'll probably get a case and keep it going from there. ADJ says, thank you for your work amid changing my life, brother. I'm happy this is life changing for you. That's the goal of these streams, to hopefully give you some more information every day, and yeah, I guess change your life. That's the goal. So I hope you're getting value from it. Live unboxing video, yeah, I will. I'll do it live on the Market Open stream, and we'll do it then. If I get it October 6th night, I'll wait till October 7th to open it in the morning. If I get it October 5th, then I'll just do it October 6th. All right, some equity updates. SoFi down 746, down 0.67% in the pre-markets. PayPal down 0.9% in the pre-markets. S&P 500 is right now, we ended yesterday at 430, 429.80. Or sorry, we ended yesterday at 432. So S&P continuing to teeter in this 429 to 432 range, trying to find what is the sweet spot for the S&P to actually sit at. Netflix is down a little bit. NVIDIA, 421. That's up from 412, which is really good for NVIDIA. Google, 131 down in the pre-market. Robinhood, 962 down in the pre-market. I did buy some Robinhood options yesterday and SoFi, so I picked up some more Robinhood and SoFi yesterday. The options I looked at got pretty cheap, and so that's ultimately why I wanted to get a little bit more. Disney is down at 81.01. Pound share 1422, 1407 right now in the pre-markets. Not as bad as it was yesterday in the 13s. Pound share getting really good resist or support in this 14 level range and not really moving too much from there. Truist 2857 in the pre-markets. I think there was an analyst that upgraded Truist yesterday, and that's why it went up a little bit. And it hit, I think, 29 at one point. Regionals are in a tough situation right now. Banks are in a tough situation. Obviously, higher for longer, it sucks. If it's just high for longer versus higher for longer, we have a little bit of a different scenario, meaning interest rates won't go higher, but they'll be high for longer. But overall, banks and equities, are struggling in a lot of different areas. Are you bullish or bearish on Robinhood? I am bullish on Robinhood. I like Robinhood. I think Robinhood's exciting. And ultimately, $10 billion market cap, $7 billion in cash, $3 billion for the brokerage. The brokerage is now gap profitable. You've got Arnie actually put out a good tweet today. Robinhood cut layoffs. Let me read his exact tweet. He said Robinhood in Q2 generated 50% revenue with 40% fewer employees. So the revenue per employee went up 150%, that's pretty insane. Let me actually share this picture right here. This is actually from Robinhood themselves. Okay, here we go. Yeah, Johnny, I think if the audio is messed up for you, it might be you because the audio should be good on my end. So right here, total net revenue in millions, it increased 53%. Average employee count went down 39%. So the average revenue per employee, 150% increase. That's pretty amazing. They make about $871,000 per employee at Robinhood. And so Robinhood is one of those companies that at this valuation, I think it's just stupid. And eventually the market will figure out. The problem is we can't have Robinhood explode in terms of its stock price unless the whole market explodes. And quite frankly, that's just so if you're buying Robinhood, you're buying it for the inevitable bull market because Robinhood will seriously return well when that happens. But that's going to take a while to happen. So it's not going to happen anytime soon. Sasky says, what differentiates Robinhood from all the other competitors, i.e. Moomoo, Webull? Honestly, it's the user experience. And I know that's not the best differentiation, but it is true. Like the user experience on Robinhood, quite frankly, is just phenomenal. And if you haven't used it before, it's hard to, get a grip of why that's the case. But it's a great user experience. It's a sticky platform. Once you're on it, you're not leaving. And as a result of that, it just ends up having a moat. I mean, even the Roth IRA, they have 325,000 people that opened up a Roth IRA with a Robinhood. I mean, like a retirement account on a little old Robinhood, $1 billion in assets just in that. They had 16% annualized increases year over year in deposits in Robinhood. That's billions of dollars every year extra than there was the previous year going into Robinhood, not Bank of America, not JP. It was going into Robinhood. And so, I mean, they've just really executed really well in a high interest rate environment. They also have $7 billion in cash. So the Fed's fund rate, 5.25%, they're making, a decent chunk of revenue. They're making almost trailing 12 months, almost $845 million in revenue off interest rates. And then on top of that, they give you 4.9%. So they're attracting so many customers because of high interest rates in terms of customer acquisition or high yields for savings. So I think it's a really, really strong thing that they're doing. And ultimately it's going well. Joseph says, am I the only one with choppy sound? Sound should be good. Sound for most people, I think, is fine. If your sound is messed up, it's not my audio. The way I'm looking at it, my audio is fine. If it is for a lot of people, let me know and I'll replug it. But I think it should be fine. Vlad of Robinhood is executing better than Vlad the Impaler. Yes, that is exactly correct. All right, let's move on to our first story of the day, which is this nice piece on CNBC around Apple and Google. So apparently, you guys know how Google pays Apple like $15 billion a year to be able to be the default search engine. Apple is having to testify about that in front of Congress around Google. So let's get a little update on this. I thought this was a fascinating thing to see. Obviously, Google is in the midst of a lot of legislation right now that could potentially negatively affect it. And so here's Apple having to deal with basically saying why they give Google billions of searches a day for $19 billion.
Trust a trial against Google. Apple executive Eddie Q will testify today, likely about the deal that made Google the default search engine on iPhone and iPad browsers. Steve Kovac joins us now with more. It's kind of intriguing.
Yeah, it's a big one. Yeah, so Apple's Eddie Q expected to testify today in the government's antitrust case against Google. And so you guys might be asking, why is Eddie Q at a trial against Google? Well, he's in charge of services at Apple. That includes the App Store, Apple TV Plus, Apple Music for you, Joe, and the billions a year Apple collects from Google to keep Google Search the default on iPhones and other Apple gadgets. And that's the key to the government's case against Google, alleging Google uses its deep pockets to pay companies like Apple, Samsung, and more to be the default search engine, squeezing out smaller competitors. Now, I'm told by...
Real quick, I think that argument kind of sucks. I mean, at the end of the day, Google is the best search engine. Obviously, Apple's going to charge them to be the default. Like, if Yahoo was the best search engine, Yahoo would be paying Apple. So, I don't know. This whole idea of smaller search engines can't compete. It's not because they don't have money to pay Apple. It's because they don't have the data that Google has, and that's just because Google's a better company.
Sources familiar with Q's testimony today, he plans to defend the arrangement with Google, saying, for example, he believes Google is the best search engine and that users still have the option to switch their default. He'll also say Apple doesn't make its own search engine because Google's is already there and they consider it the best. And Apple doesn't need to allocate all those resources to building its own search engine. Now, some perspective on why Q would defend the arrangement in federal court. Those Google payments go towards Apple's important services revenue segment. And according to analysts at Bernstein in a note just last week, Google will pay Apple about $19 billion this fiscal year. That's about a quarter of all services revenue. Now, the testimony is likely going to be closed today. Another Apple executive testified in the same case last week. His was closed as well, but we're going to find out for sure later this morning, guys.
You're going to, if something really major happens, you'll let us know. I hope.
Absolutely.
Will you know? What are they? Okay. What would be a totally surprising outcome in your view?
First of all, if it's open. Now, Apple and Google have fought to keep these testimonies under seal because a lot of trade secrets are being passed around in this trial. What everyone wants to know, though, is how much is Google paying Apple? You know, we have that $19 billion estimate. In court, there was an estimate that went from like $4 to $7 billion. Apple kind of refuted that, but we've never gotten the actual number from Apple on this.
All right, so Steve, last week we had Tim Wu with us.
Yeah.
He was one of the architects of the Biden administration's antitrust policy.
Right, and he
kind of
left
going
recently,
after this.
yeah.
He left recently, so he's talking. He joined us last week. He said that he thinks this is a really strong case for the government. I kind of said, look, this is the equivalent of somebody selling the end of the aisle at a grocery store.
Right.
If there's another bidder who will come in and pay more, how is that anti-competitive? You could see Bing potentially paying up for something like
They could,
this.
and they could if they wanted to, but Apple keeps towing the line between, there's an irony here, right, Becky? You have Tim Cook coming out blasting the business models on the privacy front for Google and Facebook, yet still choosing the lucrative Google deal to keep that search. They say it's the best. Maybe they really believe that, but they also believe that $19 billion a year that we keep talking about is super important to them. So if Google loses this, that's bad for Apple.
Right.
19's up there. I wish you had been here for that conversation with him, because he basically said everything Lena Khan has done has made sense because consumers have been so harmed. And I said, well, where? And he kept falling back on the healthcare sector for
Right.
where they had
Healthcare is one thing. I get that. Technology is a little different.
Then it came. Then 2 days ago, the article was a hedge fund that's made hedge funds that have made
Right.
so much money betting against Lena Khan.
And that's been the whole thing with this regulatory scrutiny we see with big tech is where's the consumer harm? You can kind of see it. So much of this is affecting developers and people kind of behind the scenes, but you and me, we're still paying, $10 a month for
Right.
Spotify
He
or whatever
argued it was
be.
perfectly reasonable for Lena Khan to bring a case against every single situation to see what sticks. And it made me think,
He did say that
in
there's
this
a cost
case,
to
it's
losing.
guilty before innocent. We're going to assume that this is bad.
And by the way, they're still fighting the Activision deal. That's
Right.
We thought it was
Yeah.
over. It's not over.
This is really interesting. So essentially, now we know the deal. It's 19 billion. It's not 15 billion. All of us thought it was 15 billion. That was like the reported number that was out there for so long. $19 billion Google pays every year to be the default search engine on Safari. Let me know if you use Google on your Safari iPhone. I've only used Google. I've had the option to switch many times. Google has been the thing that has worked the best for me just in terms of, search results. So I've been using Google always. I mean, really, I've had an iPhone since 2010. So for the past almost 14 years, I've been using Google on that. So it makes sense for Google to do this. I think this is a weird way to kind of sue Google. I mean, look, you're basically saying Google has too much data. They're the default search engine on iOS, so there's no competition. There are other search engines. There's DuckDuckGo, there's Yahoo, there's all these apps you can download to be able to do searches. At the end of the day, Apple either has to create a search engine, which I don't think they want to do, and they're probably not going to be good enough to be able to do. If they wanted to do this, they would have done this in 2007, and that would have screwed them even more in terms. Imagine Apple having 2.5 billion devices and then controlling all of the advertising and all of the essentially discovery of content around search because you own the device. They already control a shit ton of everything else. Now you're controlling search. So it definitely doesn't make sense for Apple to have their search engine. Then you want to blame Google for just getting into a good deal in 2007 when Yahoo could have offered more. Alta Vista could have offered more. Ask.com could have offered more. The reason they didn't is because they all suck. They're not as good as a search engine as Google. So I don't know. This case is not interesting enough, I think, to be able to really go after Google. I mean, what? You're not going to make them the default search engine? Because if you don't, people are still going to use Google on their iPhone, or they're going to manually turn it into the search engine, even if it's not the default de facto search engine. So yeah, exactly what Saskia says. People will use Google whether it's the default or not. I don't know, man. There's probably some other better arguments to go after Google, not the search engine stuff on the iPhone. I think no one is really complaining that Google's. See, this is the problem with some of the politicians. They think that they're fighting for the consumer. Like Joe Biden. Did you guys see what he put out the other day? Not to get super political about this, but he tweeted, ticket prices are too high and we need to solve this issue. And everyone in the tweet is just like, bro, like concert prices, Taylor Swift concert prices is what you're concerned about. No one gives a fuck about Taylor Swift concert prices. Like, if you're gonna pay $5,000 to see Taylor Swift, you're gonna pay $5,000 because you're a Swiftie. Like, you're gonna pay that. Yeah, it's gonna happen. She's a big star. There's a lot of supply, or there's a lot of demand, little supply. There's only one arena, so yeah, people are gonna pay that much. That's not the biggest issue to worry about. And so I think a lot of these politicians are worrying about some of the stuff that no one gives a shit about. Like, solve homelessness in California. Why don't you worry about that? Don't worry about Google being the default fucking search engine on iPhones. Mario says, I'm an Amazon delivery driver, and one thing I see Chewy boxes, about 2 out of 10 houses, at least 1 to 3 boxes, and user growth is declining coming off of Rona year over year. Users will regulate, stock is oversold. Thoughts? I haven't looked at Chewy stock in a while. I did know that they are a public company. Year to date, they're down 48%. I'll have to do DD on that. I'll put that in my list. I'll look at my list. Thank you for the insight, though. That is interesting that you're delivering a lot more of these. So that's on the ground due diligence, which is important. I'll put it on the list. I'll hand it over to Chris as well. $7 billion market cap. Revenue's $10 billion. That's interesting. Just at a high level, the revenue is $3 billion more than the market cap. That doesn't mean it's undervalued, but that does mean that is definitely something to look at. So we'll put Chewy on the list. We'll see if there's something there. How long has this company been public? 2019. Okay. So it's actually okay. All right. It got to 76 at the high. It went public at 35. We'll look in that one. We'll look into that one. Imnop says, you would think that using Google for free would be enough service for free and Apple other phone makers. Yeah. Look, this is good for consumers. We get it for free. Like Apple should have to pay Google 100%. It should actually be flipped. Like, Google is such a good thing to remember. This phone is only valuable insofar as there are products and applications and services we can use on it that make it valuable. If that goes away, the phones lose a lot of their value as well. Anyone know anything about EOSE FinTwit stock? I keep seeing, but I've done zero DD on. Aaron, I agree with you. I've seen so many tweets about this. I've never done a deep dive into what this is or why it's important. Ironically, I see a lot of Tesla people get excited about this one. So I actually don't know, but we have to go a little more deeper into that one. All right, let's get some market updates. Here is JP Morgan's AJ Oden saying we see the S&P going to all-time highs in mid-2024. So we got some bullishness. Let's see why he thinks this is the case.
For more on the markets, let's bring in AJ Oden, a global investment strategist at JP Morgan, global wealth manager. I was searching for a word to describe what we've seen for the past month or so after that move off the October lows. We're in a backing and filling or something more substantial, more significant.
I think some of the volatility is just a little bit of concern about, lately we've heard this idea about recession again.
Yes.
But if we look back to, the Fed meeting and their SEP, it does seem more like the soft landing is very much in play for them. It just seems like the market's a little concerned that it's possible that, they could potentially go further with rate hikes, although it does seem like a Goldilocks scenario when you look at the SEP.
Yeah, and shouldn't they be happy that their SEP says soft landing, or are they, oh no, it's going to be a soft landing, we need to do more? That's the paradox that we always find ourselves in with the Fed. They haven't done enough because they haven't slowed the economy.
Well, I mean, you even heard Jerome Powell, Chairman Powell, sort of allude to it, right? The economy is still very strong, growth expectations rising. The consumer doesn't seem to be too fazed by higher interest rates, and I think that's where the concern sort of comes in. Does a soft landing turn into sort of a no landing scenario? And then in that scenario, does the Fed have to raise rates higher? And then if you're in that scenario, do you then move into a recession? So I think it's almost like we're getting closer to what's the next phase, and then how does the Fed navigate rate cuts, or do they actually get to cuts before hikes?
So his argument is that we're likely going to have rate cuts before we have higher interest rates, which is the logic for why the market can go higher in 2024. Here's someone going a little more deeper on that. This is my girl. You guys know I love her, Gabrielle Santos. So she was on last night, and she gave a little bit broader of an explanation for why inflation will hit 2% a lot quicker. Let's listen to what she has to say.
To break down these crucial moments of the last little while, we obviously see 10-year Treasury yields at 455 or so, oil's up near $90 a barrel, and there's a little bit of an undercurrent of anxiety, I guess, that's happening without necessarily an acceleration in the economy. So is that correct? Worry?
So a bit surprising to see the 10-year up 10 basis points today. Nothing seems to have fundamentally changed.
Yeah.
I think for the stock market, really since the end of July, the pop in yields has been concerning. You can see that in the bigger correction in the longer duration stocks, as well as some of the year's winners. But I think in September specifically, you also started to see some growth fears emerge. That's behind cyclicals, down 3.8% versus defensives hanging in there better, down only 1%. And I think it's just this nascent realization that the third quarter is probably the high water mark here for growth. That growth is set to slow from here. That is consistent with a soft landing. It's just that it is slower. It is not blue skies ahead. And there are some building laundry lists of concerns out there that could make for a soggy fourth quarter here.
So even in a soft landing, you do land. So there is a deceleration underway. I mean, to what degree do you think the economy is going to be able to absorb it? I think that, to me, is the big question. If the Fed says, look, we think the economy is strong enough, we're in no hurry to cut, we need inflation to come into line, the market seemed to hear they're not going to be sensitive to slowdown fears that really start to pick up.
So I think the ability of the economy to have a soft landing very much depends on the labor market. This idea that you have a normalization in the pace of job growth, but you don't have a collapse, and that you can have a better mix between the demand and the supply side just by lowering job openings at the same time that you have an increase in the labor force participation rate. So far, that's played out, and so far that's consistent with a soft landing, but it all comes back to the jobs market. I think for the Fed, really the view that we disagree with is the path for inflation from here.
I disagree with them too, Gabriella, and she's going to explain why they disagree.
We think we'll get back to 2% much faster than the Fed seems to think. And as a result, that leaves the door open for rate cuts, even in a soft landing scenario, in a way that's faster than what's being priced in, certainly across the curve. I would have voted in the survey you had previously. Yeah. I would be hard pressed to choose between stocks and bonds, but I would have chosen bonds over cash in that scenario of being very close to peak rates.
So you think that...
So here, I mean, she's essentially saying, look, the Fed is wrong on inflation, and we're going to get a soft landing, but we're likely going to get rate cuts within that soft landing versus just high for longer and not getting any rate cuts. What's interesting she's talking about here is that if she had to pick between stocks, bonds, and cash, she would pick stocks over bonds. So she's basically saying, screw your little 5%. I'm going for stocks because stocks are going to be fine. And then if she had to pick between cash and bonds, she would pick bonds. And the reason she's saying that is because the 10-year, which I'm going to check on right now because I haven't checked this morning, was up 10 basis points yesterday. It's down a little bit more today, thank goodness, because we need it to come down a little bit. But the yield on the 10-year has been going up precipitously, and it's been pretty annoying for stocks. I think that's also why we saw a little bit of downside momentum in the futures, because when the yields went up, look, you're getting 4.5 on the 10-year. That's not good, man. Like that's pretty tough. It's definitely pretty tough to be able to see. And on the 2-year, I think we're at 5.1 now. As long as we still stay elevated in that area, it's not going to be the easiest for stocks to go up. Now, however, one of the other prevailing narratives, 2-year down just a little bit in the market, is that if we can normalize a 5-year or a 10-year at 4 and a 2-year at 5 and still be able to maintain inflation coming down, that's not the worst thing in the world, because a 10-year at 2 means less liquidity, or sorry, at 4, it means less liquidity coming into the market, right? Because you're getting 4% on a 10-year. So why would you kind of take risks? There's always going to be a segment of the market that doesn't want to take that risk and just piles their money into buying up US debt, which is fine. Now, if the 10-year was at 1%, everything would be going into stocks. That's not happening anytime soon. We are not getting a 10-year coming to COVID levels anytime soon. So Gabriella's point is like, we can normalize the 10-year and the 2-year being at the levels that they are. She thought it was a little ridiculous that it went up as dramatically as it did yesterday, but there still is room for it to go up, just not that fast, and then normalize at those levels. And if the Fed is wrong about inflation, meaning they're just dead wrong on the 2% levels and when we're going to get there, and we get there earlier, then there's going to be a broader chance for us to have a really significant soft landing. Philip says, if you get the bond and then the yield goes down, you make money on the bond price. They're trying to time that. That is correct as well. And I mean, you can trade bonds just like you can trade stocks and futures, right? It gets a little bit more complex, but in general, the 10 basis point increase yesterday made a lot of people money if they were holding those bonds. And that's it. And as a result of that, it crashed stocks, because obviously, why would I put my money in stocks at that point? So that's a little bit of the scenario we're having there. I think what we're seeing right now in the pre-markets is a lot of red, is a little bit because of that rise in bond yields that we had. Until bond yields start to come down a little bit more normally, we're not going to see the rise in stocks. And what controls all of this at its core is inflation. Inflation starts to come down. The market, no matter what Jerome Powell says, will start to feel the Fed is going to be more likely to cut rates, because you just don't need rates this high if inflation is coming down. Like, the only reason we have high interest rates is not to contract the economy, not to cause a recession, not to have massive unemployment. It's to lower inflation. All the things I mentioned are byproducts of raising rates, a contracting economy, unemployment, etc. But the core thesis behind raising rates is to get rid of inflation. That is the reason. If that comes down easily, the Fed can scream this higher for longer narrative all they want. It's just likely not going to be the case when you've got inflation at 2% earlier than that. And so we will see. We will indeed see. All right, let's get into the next topic of the day that I want to discuss. We got 18 minutes until the market opens. This one was an interesting one. This is one we haven't talked about in a long time, but I think it makes sense that we talk about it a little bit right now. Is Meta and Meta's Threads. So remember that app that Meta put out that was going to be the Twitter killer? Yeah, it's struggling just a little bit. I personally have not used this app for a long time, but this app is now still struggling in the context of Elon. So Meta's Twitter throne, Threads, ranks near the bottom of the most popular social apps, ahead of only Tumblr. You guys remember Tumblr? Tumblr was a thing back in the day, as measured by the number of US users. When Threads debuted, it rapidly gained millions of users, and due to its part easy sign-up process, literally the sign-up process was, if you're on Instagram, you can press one button and boom, you're on Threads. And so that's why they got a lot of easy signups, but the retention on that has not been good. Threads needs to establish an identity that's more than an extension of Instagram or an alternative to X. So they did a lot of numerical reviews to try to figure out, what's going on with Threads. And they basically saw that not only the users are down, but the engagement on the users are not as strong. Enberg said Threads needs to establish an identity that's more than an extension of Instagram. TikTok was able to break through largely because it offered users a unique social experience, and Threads is not really doing that. If you have downloaded Threads or used it at all, it's really just like a pile of crap. I mean, it's just a bunch of brands that have access to it that are trying to use it to get attention, and it's just not anything engaging. Insider Intelligence says it expects Threads to have 23.7 million users in the United States, far behind Facebook, Instagram, and TikTok, which have 177 million. Its closest rival, X, will have 56 million in the United States. That's Twitter. The forecast said, which means that Threads will have less than half of the U.S. user base of the messaging app formerly known as Twitter. Now, Twitter having 56 million users in the U.S. isn't the best thing as well, given TikTok, Instagram, and Facebook have 100 to 200 million each. But it's more than Threads, and those users are engaged. That's the good thing about Twitter. The people in the US that are actually using it are engaged with the product, and they want to use the product. Now, one of the other reasons why this is happening is there's not enough content on Threads that's interesting. So Mark said this a couple of months ago, right, where he said he doesn't want political content. He wants, motivational content or sports content or Kim Kardashian's ass or whatever he thinks that people care about on Threads. Which is fine, but for the far majority of people that use a text-based product, especially a text-based product that requires you to intellectually think a lot more about stuff you're saying, whether that's finance or politics and all that stuff, you don't get that stuff on Threads. And if you're not going to get that stuff on Threads, you're just going to get a little nonsense. Like, I'm looking at the thing right now, and it's just, I don't know, it's not that interesting. You got this guy popping up, I guess, which is fine. but there's not a lot of content on this platform that makes it exciting. So I would like to know if anyone uses this platform. My biggest critique of Threads has always been that if you want to have large scale communities, you're going to have discussions around topics that are kind of controversial, like politics, like Democrats, Republicans, like stocks, right? Palantir, Tesla. These are huge communities in text that are not the easiest to be able to create. And one of the things, that underscores this is I did Palantir Bullets yesterday with Arnie, and at the end of the talk, we discussed the fact that we're so lucky that Palantir has turned into a community, right? There are very few times in an internet life cycle of a group of people where hundreds of thousands of people can come together and you actually know some of these people by name, and day in and day out you're talking about the same subject, you're talking about news around the same subject, you're having memes about the subject, you have people that are really good at certain parts of adding to the conversation in the community, and Palantir has turned into that over the past years, and it's only going to get bigger and bigger as the company continues to execute. So it's really exciting that there's a real community about Palantir, and that's uniquely on Twitter. It's not on TikTok. It's not on Facebook. It's not on Instagram. I have a Facebook group for Palantir. It's not the level of engagement. Like, Twitter is that unique place because it's a text-based messaging platform that actually facilitates that conversation to happen. Unless Threads taps into that, I think it's very difficult for Threads to be able to create the sticky level of retention to get people to use it. And so it's hard, in my opinion, to make that happen. So we'll see. I also don't think they're monetizing Threads, which is another issue, right? If they're not making money off that, investors are probably not going to care too much about it. But so far, nothing too crazy from there. All right, let's get Jason Trennett on. This guy's been a bear on the S&P the whole year. When the S&P was at 460, he was being bearish. He has not participated in the rally at all. And he's been pretty level-headed about why the S&P or why the market has been irrationally up this year. Let's get his perspective on why the Fed is fighting the federal government themselves.
Know already, Jason Trennett is here, longtime friend of the show, so you probably do know who he is.
Long-time bear.
If you don't know, it's chairman and CEO of Strategas Research Partners, which is
literally they introduced him as longtime bear. That's hilarious.
Is a Baird company. And Jason, you have been bearish for a long time. Your concern at this point is that it's higher interest rates that's really putting pressure on the markets.
Listen,
right
we got bearish last March of 2022, and I would say we stayed bearish this year, but largely I would say for the wrong reason, because we were expecting a recession. Now we also, I have to say, we did expect. I do think inflation's sticky. I think there are elements of inflation that are structural, which means that long-term interest rates should stay higher. So we got that part right. But I have to say on the economy part, the economy is still, especially if you look at the labor market, you have claims at 201,000, unemployment rate still at 3.8%. So there's still tightness in the labor market, which is important for the Fed because that is a big input into the way they look at inflation and interest rates.
Well, look, we spoke with someone earlier who just pointed out that the JOLTS rate is not the same, that's seen some impact where you don't have people as willing to quit. And that's an indication that maybe the job market's getting a little tighter.
It should get tighter. It should get tighter because profit margins have been under pressure for 3 quarters in a row. I mean, one of the things that people have talked about, it's a theory, is that there's been some job hoarding on the part of companies, which is to say that despite the fact that profits have been down, albeit modestly, normally companies would lay people off if margins were under pressure. This time, it's been so difficult to hire people out of the pandemic that they're holding on to them. They're saying, like, well, gee, it was so hard to get these people in the first place. We're going to hold on to them. We want to see, we're going to have to see real pain and profits before we let people go. Now you might be getting to that point where quarter after quarter, if that starts to happen, you start to make different choices.
So what does that mean you are? You think that we're going to, if we're getting to that point where companies are willing to actually start firing people because margins are getting squeezed, which some people think we are second half of this year, is that good news or bad news? Do you want to see a labor market that is a little looser, and so then you don't have the Fed continuing to raise rates and you don't have the same sort of pressure on wages? Is that what you're kind of advocating for? Is that good news?
It's tough because if you get markets don't do well in recessions. Okay, so there sometimes there are profit recessions without there being economic recessions, but it never goes the other way around. If you have an economic recession, you always have a profit recession, and markets get tagged. So what you're hoping for, of course, is the proverbial soft landing, where you slow it down just enough so that the Fed doesn't have to tighten that much more, or it can actually start to ease. The issue, though, is I do think there are changes in the labor market and the global economy that mean that inflation could stay higher for longer, even if the economy slows. I think you've had an end to globalization, which I'm convinced is going to keep prices higher. You have environmental policies that, in my opinion, that are keeping energy prices higher for longer. And then you have a federal government that's running budget deficits of 5 to 6% of GDP without any sort of idea of what the consequences are. And 65% of government spending is indexed to inflation. So in some ways, the Federal Reserve is fighting the federal government to get inflation down. And so even if the economy slows, the hard part might be that Fed funds rate stays high, or that interest rates stay high. And that will be a challenge for investors. It does suggest that you want to be more towards companies that are providing profits, cash flows. You want to stay away from the long duration assets.
The 10-year really is at 4.5 now. I just thought it is at above 4.5. So I'm trying to figure this out. You were wrong for the wrong reason. Does that make you feel better than if you had been wrong for the right? And if you were wrong about the wrong reason, does that mean you were right?
No, it's such a douchey question, bro. He's like, you haven't made any money this year, and the stock market's finally pulling back a little bit. Do you think you're right?
Two wrongs don't make a right. So
right.
I'm confused.
No. I think, listen, the fact of the matter is, I have to say, Joe, I still think the chances of recession are pretty high. I mean, simply because
Well, it just means the Fed's got to even go further to cause a recession, which is still playing into your negative scenario.
Yeah, I mean, I think so. I mean, I think I would have expected to see one now, but right now, if you look at this thing called the Taylor rule, a very wonky thing, but Taylor rule would suggest if you want to get inflation to 2, you have to get the Fed funds rate to 8.5. Now, that's not going to happen because we're going into an election year, and the Fed wants to remain independent, and the Fed would be a department of the Treasury Department.
We want to remain independent, so we're not going to do what's going to make you mad. So that we're not going to do what we would like to do, which will make you mad.
Right for the wrong reason.
But right for the wrong. Maybe that's right. Yeah,
maybe that's what.
Yeah, I'll take it. I'll take it.
I think I wouldn't question that because you did say. I mean, I pushed you pretty hard. You stuck to your guns. You never. Through the chat.
Yeah, we're trying.
Well, it's not.
No victory lap here. No. We still got plenty to.
That's wild, bro. He's like, yeah, we got plenty of pain coming up. We're not taking a victory lap yet. Look, I mean, at the end of the day, I think he's wrong just off the sheer fact that we don't need 8% interest rates to get inflation to come down. I think we're going to see it very soon in October and November CPI. If you look at Trueflation, which is, I think, probably the broader gauge of like what's going on in inflation, just given the methodology they're having, we're at 2.5. And this is down from 2.7 last week. And the reason it's coming down, one of the main reasons, is because of housing, as you can see, coming down pretty dramatically. This is back in September 29th, 2022, 12.63%, has gone all the way down to 3.51%, and that's coming down even more. This is about 23% of the CPI data that's estimated, and this is going to be coming down. And so there are definitely some things that have gone up. One of the things that's gone up for sure has been obviously gasoline. We've seen, you can look at gas right here in July. Gas was down 27%. Now it's basically up almost 3% or it's down a little bit from last year, but it's still up significantly because gas prices have gone up and the Saudis haven't really helped in that. So there are pockets of the economy where things have gone amok, if that I think is a word, and it's ruined stuff, but it's not the total overall gauge of inflation. Gas prices right now, Brent oil is 91. So we were at 95 last week. We've come down to 91. Not horrible. If we can normalize that, maybe we get to 85 by the end of the year, if not by the beginning of the year. I think a lot of those things will normalize. The rents are coming down. There's going to be a lot of reasons for why 2% inflation is going to happen. The question is, when it ultimately does. Rajan says, yo, man, moved into university, so haven't had much time to tune in, but it feels good to be back in the live. Rajan, what are you studying in university, and what year are you? Freshman, sophomore, junior? I'm happy you are here. Happy you are enjoying it. I used to watch a bunch of YouTubers when I was in university, and I still remember them because I used to watch them every day. So it's really cool that I am one of those, people that you can consume while you're in college. So that's super awesome. And let me know what you're majoring in as well. I think we would all love to know. Are you a finance guy, computer science guy, gender studies guy? Anything you do. The point of university is to have fun, in my opinion. Like, the education is secondary to, the actual fun stuff. But let us know what you're doing. All right, so we got about 5 minutes until the market opens. Let's see what we've got going on in the current markets. NASDAQ at 13,271, S&P 429. It looks like it's going to be a bloody open, quite frankly, because that 10-year popping up to 4.5, that's tough, man. That's like for equities, that's not the easiest thing to deal with. So I think that's going to be a little bit of an issue. Where is Tesla doing? Tesla was at 230 yesterday. Wow, 243. Okay, so it was at 237 yesterday. That was the low. 243. People have asked, is this a time to nibble at Tesla? I definitely think if you're long term, yes, this is a nibbling opportunity. However, if we're headed down in the overall market, Tesla's not heading up. That's for sure. And so if you expect a little bit more pain, which I definitely think is reasonable, right? We're 9 points away from 420 on the S&P. I totally think that's reasonable, especially if this government shutdown thing actually materializes into something pretty dramatic, which I don't think it should, but if it does, then we're going lower. Like, it's just that simple. So I think DCAing into some, like SoFi to me is a better DCA than Tesla right now, because SoFi, yes, it could go lower, but it's already pretty beat up, right? Tesla, I don't think is as beat up as people think it is. I mean, it's not as this one can drop a lot more. So can Palantir, even though Palantir has been showing phenomenal resistance, support at this $13.70 range. But now it's at $13.98 in the pre-market's $14.22. It's been hovering in that $14 range, so that gives you a little bit of reason to think you could invest there. Tesla, I think, can keep falling. Same thing with Square. I mean, this seems to be definitely a bottom for Square, but can it fall lower? Yes. I personally am not a buyer of Square. I know people that are excited about Square. I've never been excited about the company. I do think it's undervalued, but never been super, super excited about it, which is why I'm not buying. But there are people that are interested in that. Rajan says, I'm studying economics, but just started second year, so no more fun years. Gotcha. Yeah, economics is a tough major. It's not the easiest. Because it's, especially when you're studying like macro, there's a lot of like theory you have to study. And then when you get on the test, you have to actually apply formulas. It's not as easy as kind of just like understanding the news and what happens, which is, I think, the only stuff that really matters. But when you're doing it as a major, it's definitely a lot more demanding. So makes sense why you're in this stream if you're studying econ. Bank of America, 27.60, JP Morgan, 146, PayPal, 58.38. 38 cents from getting below the 58 level on PayPal. Nvidia holding up nicely at 420, at least, not being too bad. Robinhood down to 958. Yeah, we're going to see some pain in the now, but see, remember what happened yesterday? We saw a red market. It opened up pretty damn red. And then within about 30 minutes, we saw the green candles all the way up like clockwork, all the way. I think I was down 3,000 for the day, and I ended up like 2,000 for the day. So it was a nice little swing in terms of the portfolio, because institutions came in and they bought the dip. It was definitely, I mean, when it happened all at once in a synchronized symphony, it was all institutions coming in and picking up these shares super cheap. However, it's down again today. So you got those same institutions probably dumping them in the pre-market because of a variety of factors, one of those being the 10-year starting to explode. So it'll be interesting to see if that same thing can happen today, or if we see a little bit more pain as we enter into the markets. All right, we've got about a minute until the market opens. One of the other pieces of news yesterday was that the writer's strike has been somewhat concluded, and that means we're going to get a lot more content soon on these streaming platforms. If you guys watched yesterday's Finance Junkies, Chris had a little bit of a change of heart on the beloved Disney, and one of the reasons he had a change of heart was because Disney didn't do that well in the negotiations. Ultimately, they gave up a lot of stuff to the actors and the writers, so they're not going to be able to have all the cost cutting they would want as a result of AI. And then overall, the thesis around entertainment has been a little shifted. I think because he's getting a lot more bullish on Google, which he talked about yesterday, and YouTube is such a big thing that's growing for Google that has basically zero cost for content. Disney, Netflix, Paramount, the fact that they have to pay for content. My thesis for why I've never owned these companies has always been, I just don't believe that paying for content makes sense when someone like me will get up in the morning and make content for free for YouTube, right? Because I care about building a channel. And there's hundreds of millions of people like me that care about that, and billions of people that are going to come online and also care about building a channel. That's just going to grow. Disney is going to have to keep coming up with the next Frozen, the next Mickey Mouse, and that's just not as easy to do versus user-generated content. So it'll be interesting to see kind of how that plays out along with the writer's strike coming to an end. All right, here we go. 9:30 a.m., second day of the last week of September trading. September 26th. Thank you all for being here. The stock market is now open. Wake your ass up. Here we go. Palantir opening 1.79% at $13.96. Disney opening up 0.72% at $80.43. SoFi, $7.41, opening up 1.43% down in the market open. Tesla, $242, down 1.7%. Nike, $90, down 0.56%. Amazon, $130, down 0.90%. Netflix, $383, down 0.39%. ARK Innovation, $38.56. This one is up 30% for the year, but it's been getting hammered over the past month. It almost hit 50 back in July. Now at $38.63. NASDAQ, 13,185. So we're down 86 points, 185 points from the 12,000s. We haven't seen the 12,000 range on the NASDAQ yet. Remember, the top for the NASDAQ, November 2021, 16,000. So we're about 3,000 points down from that original top back 2 years ago. S&P 500 opens up at 429. In the pre-markets, down 0.68%. Down, almost 1%, but nothing too crazy. We'll see where the rest of the market goes, but we are indeed down on the S&P at the same levels we were yesterday. Google, 130, down 1%. Enphase, 120. Enphase has been doing a good job staying in this 117 to 120 range. It hit 116 at one point, but it hasn't collapsed to the 105s, 103s. We haven't seen that happen yet. And I think if the whole market, falls, that could definitely happen. But Enphase staying afloat at 120. Meta at 297, Square at 45, Microsoft 314. MicroStrategy bought another, I think, 500 Bitcoin yesterday. They're down about $543 million on their overall Bitcoin position. I think their average price is around 30,000 or 32,000. Bitcoin right now at 26,000. So, there's not that much for them to break even. If it's in that 34, 35-ish range, Bitcoin has to go up. I know it has to go from 26 to 34, but it definitely seems more reasonable than 26 to 100, right? So, MicroStrategy did pick up more Bitcoin yesterday. They are down about $500 million on that. Stock right now, $324, down 1% for the day. Apple at 174. Again, iPhone 15 demand seems to be insane. Maybe we'll see that in the numbers, and maybe this is a dip that's worth buying if that demand is insane, but I don't know if that demand is going to be enough to deal with Apple's slowing revenue growth. QQQ at 356. ARM at 53. Yeah, ARM is still up above its IPO. That's really good news for the ARM shareholders because I don't want there to be bag holders. I actually want there to be a nice IPO market so that more liquidity can come into the markets. But it's really nice that ARM is not below the IPO. Instacart is barely below the IPO. It was at 31. It's at 30.17. So Instacart and ARM actually holding up reasonably well for their IPO. You didn't expect that, but they're not doing too bad. Duolingo is down. Mercado Libre is down. Upstart is down. Opendoor a little bit green in the pre-market or in the opening market, and Lucid at 514. It's up 14 cents. It was down at $5 yesterday. So that one's a little green as well. Shopify's down. Unity is down. Confluent is down. We got a lot of red. If you look on the left-hand side of my screen, there is a ton of red that we are seeing right now. Oh, they bought 5,445 Bitcoin. Holy crap. I thought it was only, wow, that's a lot of Bitcoin. Oh, so they have 158,000 at 29.5. Okay. So they have 29.5 as break even. That means they can break even very soon on Bitcoin. Yeah. So MicroStrategy actually is not in a bad situation. Let's see. That's not too bad. 29.5 as a break even is not horrible. Netflix at 382, Amazon 129, and where's Palantir at 1394. So we got a red market opening up. We probably expected that. A lot of the 10-year price action is being baked into some of the fears that we're seeing around the market. The question becomes, when does this change? Let's get an update from Bank of America's Steven Stutmeyer on why he sees a lot of this price action eventually changing going into 2024. This is the wrong one. Here it is.
The technicals of what the charts are telling us. Steven Stutmeyer, Chief Technical Strategist at Bank of America's Global Research. And I feel a little better after looking at your notes, actually, Steven. So not to worry. Seasonal corrections occur during this time. Nothing that you see.
Bank of America has been consistent on this. They think it's September is a bad month, but outside of that, we're going to be fine.
Right now tells you it's anything more than that, which and an upward trend could resume in the next good time, which begins in November.
That's correct. Yeah. So if you follow seasonality in the market, you typically get a summer rally, into July, August. So, and after that, you typically get the fall correction. So the second best 3-month period of the year happens to be June through August. The worst 3-month period of the year happens to be August through October.
Are we through the worst of it? Is there more to come?
Yeah, good point. I mean, when I'm looking at some of the tactical sentiment indicators, I mean, we do have some important support levels that we're at now, right around 4,300 on the S&P. But when you look at something like the put-call ratio or the 3-month VIX versus VIX, they're coming down, but they're not climactic yet, meaning not enough near-term fear in the market that was associated with past lows in the market. So I actually think the low could happen below this 4,300, maybe towards 42, somewhere in the 42 handle, with those indicators triggering, meaning 3-month VIX versus VIX below 1. That's the fearful reading. And the put call, 5-day put call, for instance, somewhere in the 1.12 to 1.25 range, which is where it occurred March, December, October, and June of last year. So I think we got a little more on the downside here.
I know it's been a while, but we never retested October lows, and we never got a capitulation or any of the things you just said. We never got at 3,600. So now you're talking about 4,200 as being the intermediate term low, and you just totally took those old lows that everybody was looking to retest. Why didn't we ever have a capitulation that time?
Well, I think we did for a few reasons.
Duration, not a quick one, but a U instead of a V?
Well, I would argue this. First and foremost, we had a low in June of last year, and you retested that low in October. So that was a retest. But you did.
That's a good point. We did get a low in June 2022. Everyone remembers seeing that low, and then October 14th, the market bottomed again. It even went lower. That's actually not the worst point. We did, if you count 2 bottoms as a capitulation to an extent, there was capitulating.
You get some capitulation. One, the 3-month VIX versus VIX did get below 1 right around that time
frame.
frame.
The VIX never got above 20.
Yeah, the VIX is very strange, right? Okay. It's not really working the way it used to. So that's why I use that ratio, 3-month VIX versus VIX.
Yeah, I heard that.
And the other thing that's very interesting about last year is that when you look at AAII bears, they got above 60 in late September, around this time last year, which was the highest level that's seen since
that was
2009.
So if you looked for it, it was there.
It was there. And, we wrote about it at the time, and, everyone kept saying we didn't get capitulation. I'm like, you got it from these 2 indicators, not from the VIX.
You should have called me, because I was waiting for someone to say that you didn't need a capitulation. Well,
you got it. You got it. You just didn't get it from the indicator most people are looking for it in, and that is normally what the market does.
So you don't see credit strain, or you don't see any of the scary things that would indicate that this is more than just a correction?
At this point, no. I mean, if you look at the option adjusted spread on high yield, it's not expanding aggressively.
But thank you. You do.
That's a good one.
That's why you're here. What is it?
The option adjusted spread on high yield, high yield corporate bonds.
Not this morning.
It's quite low. It hit a new cycle low earlier this month. And then corporate BAA to 10-year spread's another important one, right? I mean, that one's below 2. When you get above 2.5, that's a problem. And it recently just hit another cycle low, right around 1.7 or so.
How quickly do those metrics change when you're getting into a bad time? And we've been talking about how the economy looks great until all of a sudden it doesn't.
Right.
How about those metrics? Is that the same thing? Like it looks great, but it can fall off a cliff?
Well, the beautiful thing is sometimes these indicators do have divergences. So if we were looking at late 2021, for instance, a lot of the indicators we're talking about now actually had their best levels, bull market levels in the summer. And right now, they still have their best levels here. So there's no real divergence at this point. But if all of a sudden a 1 standard deviation event turned into a 2 standard deviation event, you would think it would show up in these credit spreads. But I mean, again, the market has a cyclical uptrend, and if you keep it really simple, 40-week moving average around 4,200, that's the cyclical trend right there as a guideline. Secularly bullish as well. We've been big believers in the secular bull market. Maybe we're getting towards the later stages of that, but the big level to pay attention to there is that 200-week moving average, right around 3,900. Now,
look, he makes a good point. The overall point of the video is that there has been capitulation at some level, and if we have that capitulation, then this is a secular bull market. Well, a secular bull market essentially means that there's going to be cycles of different pockets that go downstream, like a correction, which is what we're seeing right now. Especially if the S&P gets to 420, we will officially have had a 10% correction down from the 459, 460 level. But the question becomes, is there something brewing in the brouhaha of the economy that's going to be a lot worse than just a 10% correction? And a lot of people are pointing to credit tightening as a result of that. And look, there may be some arguments for that, and there's definitely some arguments against that. But at the end of the day, if we've capitulated at a bottom, which was that 340, 360 range, and now we made our way up, a 10% correction is totally normal. Like, we're supposed to have a 10% correction. We're like, the fact that we went the whole year without having a 10% correction is insane, given, the craziness. We had Silicon Valley Bank collapse. You thought we were going to all have a recession there, and the Fed stepped in. So I've been saying for a while, a 10% correction is very normal. I think it's happening. I think it's fine. And what it will do is create a lot of buying opportunities for people that have just not been able to participate in the rally, that finally are deciding, hey, it's time to come in, and we'll see what goes from there. I want to give an update on commercial real estate, which I think is also important to talk about as well, because we haven't talked about it in a while. Here's a decent post on what's going on with commercial real estate. So let me read from here, then I'll give some context. Nearly 700 U.S. banks now exceed the 2006 commercial real estate loan concentration guidance. What is the CRE loan concentration guidance? It's a guidance by the FDIC for the amount of exposure that small banks should have to commercial real estate loans. These are like your typical office buildings, buildings that you rent out to commercial enterprises, whether they're small buildings or big buildings in New York or San Francisco. That's what commercial real estate is. Currently, small banks hold over 70% of CRE loans, which is about $2 trillion worth of loans. 1.5 trillion of CRE loans are set to be refinanced at much higher rates by 2025. All as offense vacancies are at historic highs and CRE prices are in a bear market territory. And then the post points out to this being a crisis. Now, a couple of points to push back against this. Number one, work from home is starting to reverse a lot more than people think it is, at least in the bigger cities where a lot of these commercial real estate offices exist. So if you go to San Francisco, Boston, New York, it's not like reversing in a crazy trend. New York is having a little bit more of a reversal, but there is a bit of, Facebook came out the other day. They said we're only doing 4 days in office versus 3 days in office. So you have to come to office and every day. Twitter, as I think, eliminated work from home to an extent. So there's a lot of companies that are like, this work from home nonsense is trash. We're not going to keep it, which means there will be a use for the office, right? So people will have to come to the office, which means there's going to be less refinancing or just less getting rid of those commercial real estate offices. The other point to this is that a lot of these 700 banks that have a ton of CRE loan concentration guidance, you have to be very specific on what those banks are. If they're smaller regional banks, they're not going to be able to handle it, which is bad for some of those smaller regional banks. If they're larger regional banks that have less exposure to CRE, they're going to be fine. And if they're Bank of America, JP Morgan, I don't even think it's going to affect them because they can withstand those losses until rates come lower to be able to then not have those losses on their books. So I don't think it's the biggest deal for some of the bigger banks and some of the larger regional banks. But if you're a small U.S. bank, you got a couple billion in assets and you're like in Alabama and you have a ton of commercial real estate loans, that's not going to be good. And so what the risk then imposes is that if there's any reasoning for why the 10,000 people that use you in the local part of Alabama find out you're underwater on all these commercial real estate loans, they're going to take their money out and they're going to put it in a big bank, or they're going to put it somewhere else that's safe. And that's the fear, that there's going to be a multiplicity of bank runs across a ton of smaller banks because they have all these commercial real estate loans that are going to put them underwater. And then if they have a bank run, obviously the bank, goes underwater. So that's kind of the fear of what's going to happen. I don't think it's a fear that should be widespread across a lot of the big banks, but it is a fear that definitely exists in some of the smaller banks. Matt says CRE is more than just office. It's multifamily, retail, and industrial. Yep, that makes sense as well. So there's more components to it than just work offices. P. Morton says, I trimmed my commercial real estate position a few months ago. WPC has been a big loser this year as well. Yeah, again, the only real estate stock that I've seen that has done really well this year, and maybe it's because I don't know a ton of them, is SLG. Palantir, look at that, 14.15. Wow. Look at that rebound. It was just at 13.98, now at 14.15. Palantir is up. SoFi is up a little bit at 7.52. Tesla is barely down. Everything was at 2.43. Now it's at 2.46. Nice little rebound. Definitely we're seeing. SLG has done really well. It was at $19. Now it's at $36. It hit 40 at 1.43. Paid a 15% dividend at the time as it was coming up. Now I think it's about a 7% dividend. And this is one of the largest companies in the New York City area that owns commercial real estate. Obviously, they're not being affected because commercial real estate in New York City is doing well. A lot of people need commercial real estate. So, or a lot of companies actually still benefit from it. But in other parts of the world, it's, especially in the United States and more suburban areas, it's not going to be the best. Netflix is down. Amazon is down. NASDAQ 13,185. S&P still at 429. Holding strong at 429.70. Not really collapsing too heavily down from there. Enphase at 119, Google at 130, Meta 297, Square 45. We do have earnings season in about 2 weeks. We're going to see earnings begin again. Robinhood having a nice tick up as well, 975. It was at 940 in the pre-markets. Robinhood doing well. Nvidia at 419. All the regionals are either flat or they're down a little bit. Truist is down, Zion's down, KeyBank is down, KRE, regional banking ETF, is down as well. Bitcoin, 26,232. I think we're about 200 days away from the halving event for Bitcoin. So that is one catalyst. Wow, Airbnb giving up some gains. Airbnb was at 140 for a while because of the S&P 500 inclusion. It's finally come down from there in the 133 range. So it was holding 140 for a while, and then the bottom kind of fell out on Airbnb. Coinbase, let's take a look at that. I haven't seen Coinbase in a while. I think that's 70, 72. Coinbase up a little bit on the day, given that Bitcoin is a little bit green as well. Red market, not super red, not super green, but definitely not horrible from there. SLG only up 6% on the year. Yeah, if you got it at the bottoms, you're up very well. If you got it at the beginning of the year, you're not doing the best. And that's why timing definitely does matter. At a lot of different instances, timing can be the difference between an amazing return and a subpar average return. I want to get an update on some of the problems we're seeing at streaming as well. Obviously, we've seen in Netflix struggle with the Writers Guild strike. Let's get an update on why streaming has become so challenging for these guys and kind of where the future is for these companies as they finish negotiations.
Hollywood Studios reached a tentative deal to end the strike, and joining us right now to talk about what it means for the media stocks is Bob O'Donnell, Technalysis Research President and Chief Analyst. So, Bob, let's talk about this. The strike is over. They're going to be paying more, but they get the content back. How's this wash out?
Well, we got to think long-term and short-term, Betty. I mean, obviously, they haven't had to pay these production costs for a long time. So obviously that's been helping the bottom line for a number of stocks. And so there was some reaction in the market yesterday when all of a sudden people realized, they're going to have to start paying again. But look, long term, it's a hit-based business. Like the music business, you've got to have new content. You've got to have fresh stuff. So it needs to happen. Of course, actors still have to come together too. Let's not forget that before any of this happens. But at the end of the day, the other thing is, it's very interesting because we're in this golden age of television. A lot of people talk about this, right? There are more shows now that we can watch than ever before. And in weird and interesting way, it's the fact of the matter is there's a bunch of people I've talked to, I'm sure friends and relatives, what have you, they're like, you know what? I could actually kind of catch up on some of these series that I wanted to watch before that I couldn't before. And that highlights the fact that really at the end of the day, as we think longer term on these media companies, it's about leveraging the library. And you've got companies with different size libraries that can leverage it in different ways. They've got some oldies but goodies that last forever. They've got the things that people want to watch all the time. And all these companies, of course, have been jockeying for years to get the access to the rights and the content they want to have. But they've got to refresh it. The question is, given how much they currently have, do they need it to refresh it as much? That is, do they need as much new content as they've been creating?
And see, the bull case here for Google and YouTube is that YouTube's library exists forever, and that recommendation algorithm can take a video from 10 years ago and put it in front of your face. And it happens every day. Old videos from years ago, not days ago, but literally decades ago, get recommended. That library works automatically because it has search-based keywords to recommend content. Netflix and Disney just can't compete at any level on that.
Perhaps not. Perhaps this
but Bob, that's just an issue of you can only be as smart as your dumbest competitor. If your dumbest competitor or your richest competitor, in the case of Netflix, is kicking out lots and lots and lots of hits, you've got to keep up with the Joneses when it comes to that. So we're probably going to see that happen again. Is there anything in this contract that makes it less competitive, though, for streaming? Because it's a business that for most of these guys has not turned into massive profits, or in some cases any profits. It's a losing expenditure for most of them. Is there anything in this contract that is going to make it tougher for those streaming services to get to profitability? I mean, they're talking about increased royalties. Probably, we haven't seen everything, but we've heard a lot about what's probably in this. Increased transparency with knowing what's a hit in the digital world and being able to pay for it. Does that give away the keys to the kingdom, or is this okay because this is, what we knew was going to happen? They were going to get some higher payments. They were going to get some guarantees about writers in the writing room. They were going to get transparency and get royalties back in this new digital world.
Yeah, I mean, clearly they are. All of those things are absolutely true, right? All of those things are going to be impacting them because the fact of the matter is they are going to get, the writers are going to be getting more for streaming. They're going to be more aware of those hits, exactly as you pointed out. So that is going to be a long-term challenge for them. So there is, look, the profitability challenges for streaming aren't going to go away. And if anything, as I said, in the near term, you've got these hits that these companies are going to take. So they're still going to have to figure out longer term, how can they leverage these things into other areas? And again, this is where you think, when I was talking about the library, but in addition to the library, it's other types of content that could be leveraged from this, from the video games to obviously parks in certain cases.
Yeah, look, at the end of the day, I think Disney and Netflix are in a tough situation. There's always going to be a need for premium content, but with the way YouTube is, the way user-generated content works, it's just going to be really hard to recommend and use your library's full extent. Like, the reason a YouTube video from 10 years ago can still be relevant today is because the algorithm can figure out why this video is relevant and who exactly to give it an impression to, which is that thumbnail and title that pops on your screen, and then why someone like me or you would click on that video. Disney and Netflix have these, and Paramount, all these guys, HBO, they have these big ass series, these shows like Game of Thrones. All right, that's a hit for everybody. That's great. YouTube can't really make a video that's for everybody. I mean, Mr. Beast is probably the best version of a Game of Thrones on YouTube, right? In terms of something that appeals to everybody. But outside of their Game of Thrones and outside of the Breaking Bads, to find an individualized series or a movie that fits for a person based on your algorithm, you just don't know enough about the user to be able to recommend that, nor do you have the library of content because you don't have user-generated content to recommend that stuff. And that's where Disney and Netflix really struggle. Any streaming company really struggles in comparison to a user-generated content platform like YouTube that can just show you anything, or like a TikTok or an Instagram, obviously YouTube being the much more mature version of those. So I think in that perspective, they're going to struggle when they try to compete against Google when it comes to content. All right, that's it for us for today. We got to do the word of the day, and then we're pretty much done for the day. And we take a last look at markets. Things are actually picking up a little bit. We still got some red, have a little bit of green. S&P did hit 428, so we're now down 428. 85 below 429. We'll see if that turns into 427 or 426. 420, I think, is reasonable for us to hit, and then maybe we see a rebound, but we'll see where that goes from there. Rest of the market is red, but not a crazy amount of red to start off the market. Today's word of the day, I've heard this word a long time, have never actually gone deep into it, but it's Pavlovian. Pavlovian is relating to or a characteristic of Pavlov or his work, especially of experiments in which he elicited predictable responses from laboratory animals. So essentially, if you have a Pavlovian reaction to something, it's as if you're a laboratory animal and it's very predictable how you react to something. So if someone says you have a Pavlovian reaction, I guess they're trying to say you have a predictable response to something that emulates something of a laboratory animal. It's an interesting word. I've heard of this word for a while. So monopsony. Yeah, this is also a word Sham Sankar, as Arnie puts in the chat, was using on his latest article. And me and Arnie were looking at the latest Palantir bullets like, what is this word? What is this coming from? Monopsy? All right, that's an interesting word. All right, everybody. That's it for me. Thank you all for joining. We'll have Fine and Chunkies at 7 p.m. A couple more videos on Palantir coming out a little bit later today. And that's pretty much it. Thank you all for joining. Hope you have a great Tuesday. And I will see you tomorrow on the Market Open. Bye, everybody. Have a good day.